Sage here for kalkinemedia. Please subscribe to the channel, press the bell icon, you'll be notified of the latest videos. In today's trending topic, we're covering, are ETFs better than mutual funds? Investors looking for diversification of their investments often turn to the world of funds. Funds such as exchange-traded funds or ETFs and actively managed mutual funds primarily provide broad, diversified exposure to a region, an asset class or specific market niche without having to purchase a lot of individual securities. And the challenge, however, lies in picking the best funds or at least narrowing down your options. So do you go with an ETF that tracks a benchmark index such as the S&P 500 index or a low-cost index mutual fund doing the same? Or maybe a fundamentally weighted index ETF, which may improve a portfolio's overall risk-adjusted return? Or perhaps a mutual fund with a reputed fund manager? The answer lies on the individual goals and needs of the investor. Before you decide on the ideal mix of the funds that's right for you, let's take a look at some of the benefits of each type of fund. So what are ETFs? An ETF trades just like a stock and is primarily a passive investment, which aims to replicate the performance of its underlying index, although actively managed ETFs are also available that seek to deliver a higher return than their benchmark. A passive management investment style has a huge benefit of lower expense ratios than those charged by actively managed mutual funds, and some passive ETFs charge even less than 0.05%, with some funds eliminating this fee completely, and that's a huge advantage over the long term compared to an actively managed fund that charges an average of 0.66%, according to Morningstar. And passive ETFs also tend to be tax efficient because of their core structure. Tracking an index usually doesn't require frequent trading, and ETFs have a structural design giving them an ability to minimize the capital gains they have to distribute. Historically, investing in ETFs has meant paying trading commissions every time ETF shares were bought or sold, but at several other brokerages, ETFs now trade without a commission. When to invest in an ETF? 1. You trade actively. If you want to trade ETFs quite frequently using stop orders, limit orders, and even doing some short selling, then they're all possible with ETFs, but not with mutual funds, because ETFs are directly bought and sold on an exchange. Active trading is possible, just like shares. 2. You want niche exposure. ETFs focused on very specific sectors, industries, or other asset classes, such as commodities, can give you exposure to particular market niches. Niche investing often isn't possible with index mutual funds, though some actively managed niche funds might be available, but at a higher cost, and you want tax efficiency. Both ETFs and index mutual funds are quite tax efficient than actively managed funds. Generally, ETFs can be even more tax efficient than index funds. However, that depends a lot on the country's taxation system. So what is a mutual fund? Mutual funds are similar to ETFs, pooling money from general public and using that money to buy securities, and usually stocks and bonds. And the value of the mutual fund company is solely dependent on the performance of the securities it has in its portfolio. So, when you buy a unit of a mutual fund, you are buying the performance of its entire portfolio, or more precisely, investing in a unit of a mutual fund is different from investing in shares of stock. They're generally bought directly from asset management companies instead of from other investors on a recognised stock exchange. Unlike ETFs, they don't have trading commissions. However, they do carry quite a high expense ratio and potentially other sales fees. Like ETFs, index mutual funds are also considered to be passive investments as they aim to replicate an index. They can also be a low-cost way to invest with annual expenses of less than 0.10%. Lower expense ratio is not a characteristic of an actively managed fund. So when to invest in a mutual fund? 1. Lower operating expense. You can purchase an index mutual fund that has lower operating expenses, and sometimes ETFs are not always the lowest cost option. You could also find an index fund with lower costs than a comparable ETF. 2. ETFs are thinly traded. ETFs generally have a thinly traded market, and you may have to consider the size of the bid or ask spread of a low volume ETF before making a transaction. Mutual funds, by contrast, always trade at NAV without any bid-ask spreads. 3. Expectation of a high return. As most of the mutual funds are actively managed funds, they are expected to beat their benchmark index and deliver alpha. For this primary reason, there is a higher operating expense. Mutual funds beating their index consistently is not very common. However, total absence of beating the benchmark performance in ETFs makes mutual funds more lucrative for alpha seekers. And thanks for joining us on the report. If you like the information, please like, share, comment on the video below. Subscribe to the YouTube channel and press the bell icon. You'll be notified of the latest videos. For more information and regular updates, head to the website kalkinemedia.com. This is Sage here for Kalkinemedia.